Well, well, well. Today, something very interesting happened. Something that me personally, I've been wanting. But when I dig deep, I do a little research and it's, well, do I really want that? What happened today was that the Federal Reserve finally decided to start cutting interest rates for the first time in years. See, what's been happening when you talk about inflation and why prices are going up and what can we do about it? Well, the inflation started to happen because there was so much money being printed into the U.S. economy. The COVID pandemic struck. Instantly, the Federal Reserve, in order to stop a recession or really a depression, started printing a bunch of money and circulating it through the U.S. economy. And that is what ended up causing this inflation that we've been living through. So in response to that, the Federal Reserve started to raise interest rates because what they wanted to do was bring the value of the dollar up, but they wanted to make it harder to borrow money. They wanted to make it harder to own properties, have real estate. They wanted to make it harder for, they don't want to admit they wanted to make it harder for the middle class, but really that's what they wanted to do. One of those things included making sure that most people stayed employed, but that we had a healthy amount of people who went unemployed. Cooling off the labor market is what they like to call it, which is really, we need people to be jobless. So all those things have been happening, and they've been ripping up the U.S. economy for years. You know, you want to hear about it, you go watch my other video talking about how inflation is killing us all. But today, the Federal Reserve decided to change course because what has happened is that the labor market or unemployment has been growing at a rate that they did not want it to grow. People are not spending money, and the United States is headed for a recession, if not a depression. So try to avert this. They have begun finally to cut rates. Let me show you this clip of Jerome Powell and see what he has to say about it. He is the basically the head of the Federal Reserve, the Fed chair.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed that made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that The actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. And I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
So now after that clip, that's what he's saying. Oh, we can slow it down, we can speed it up. Very confident that everything's going to be okay. Okay, well, this is what I'm going to tell you. Here's 3 things that could go well and 3 things that could go bad as a result of the Fed rate cuts. And mind you, they want interest rates to be down to 3% by, I believe, 2026. So we'll see how that is, because I sure would love to refinance my house. But anyway, 3 good things and 3 bad things. Let's start with the bad. So because they are lowering rates, that could cause inflation to skyrocket again. Inflation is apparently, if you believe the government numbers, now back down to 2.5, 2.4, somewhere around there. The target is 2, but because of the labor market cooling, they didn't have time to wait till 2. And so that's why they started to cut rates. But inflation can kick off again if people are borrowing money and if there's too much economic growth. So increased borrowing money and spending may drive up prices, and this could worsen inflation. And then we're back to reducing customer purchasing power. The second thing that may be bad is, yes, this may stop a recession for a while, but it may not permanently stop a recession. These cuts could spur on some short-term growth, but the recession might be inevitable because this excessive debt that the United States itself has, along with people in the United States, it keeps building up. At the recording of this video, I think we're about $36 trillion in debt. How's that going to get paid? You can't kick the can down the road too much longer. So how are we going to go? We're just never going to have a recession? Doesn't seem likely. Here's the third worst thing that could happen. A weakened job market. So if inflation gets bad again, and the Fed starts to raise rates again to control it, then businesses are going to have to start doing more layoffs again. Because raising those rates will make the cost of borrowing go up, which means that businesses won't be able to have as many employees. So basically what we're looking at is that these rate cuts are really like the last resort. And if this doesn't work, things could go very bad. Okay, that's the bad news. What about the good news? What's something good that could happen? Here's 3 good things that could happen. Since rates have been cut, borrowing costs now are lower. So loans and mortgages become cheaper, and then businesses can expand, and that can create more jobs. You know how it seems like lately nobody has been able to get a job? That's on purpose because of the rate hikes. Corporations were forced to just not hire anybody. It was almost like a worldwide hiring freeze. Well, now that rates have been cut, that means that corporations can borrow money, which means they can expand and hire more employees. So, okay, that's good thing number 1. Number 2, economic growth. A rate cut can stimulate spending and investment, possibly preventing or softening a recession. If you ask me, I feel like there's going to be a recession. Now, in terms of a recession, like a soft recession or a Great Depression, well, I think that's what the Fed is really trying to focus on. We're going to have a recession, but let's just make this soft and easy, not Great Depression levels. Okay, that's the second good thing. What about the third good thing? Job preservation. By making credit more accessible, struggling companies might avoid layoffs, supporting overall employment. Everybody loves job security. So let's hope that these three good things are what happens as a result of the Fed rate cuts. Now, from looking at it, they started with 50% basis point. That's 0.50. That's what they did at this September meeting. You know, they're probably going to do a quarter point at their next meeting, a quarter point after that. I know that the goal is to be down from, I believe we're at 5.5 now, somewhere around there, to about 3.0 by the end of 2026. We'll see what happens. We'll see, you know, if this whole system is still in place by 2026. But hey, for right now, if you're asking what happens when the Fed cuts interest rates, that's a quick little summary. 3 good things, 3 bad things. And hey, we'll sit back and see what happens. Remember, like, comment, subscribe, and bye.